Let me welcome Mr. Ashwini Kumar Tewari to our conversation. He's Managing Director at State Bank of India. Mr. Tewari, pleasure speaking with you here on NDTV Profit. Let's first get your overview. Some of these cuts have already been passed on by all major banks, including State Bank of India. You've announced a slight cut in deposit rates. What's the impact that you see going forward?
So as your anchor was saying, first of all, good morning. But the impact is that as deposit rates are cut, the repricing of all deposits, which are legacy deposits, will take some time to pencil in, because as they mature and are redeposited, the rates will kick in. Whereas for loans, especially those linked to repo rate and external benchmark, this rate cut has immediately happened. So therefore, there is always immediate pressure on margins to begin with, and over time it stabilizes. That's what's happening to us also.
Okay, so in the time lag, that's how you see the transmission pan out. Do you see the transmission being paired out over existing loans as well, and by when?
So existing loans, as I mentioned, those which are linked to the external benchmark, which is repo rate, has immediately happened. We also announced on 15th of April, external benchmark rate cut of 25 basis points, which is the RBI's reduction. So that has already happened. Now, in case of deposits, as I mentioned, the rate cut which has happened is applicable to new deposits. Older deposits will continue at the contracted rate, and as they mature and are brought again for depositing again, that is the time the reduced rate will kick in. So therefore, there will always be a lag in case of rate cut in terms of the deposit rates getting priced in, and therefore there will be some initial pressure on margins.
Sure. What is the extent of pressure that you expect on margins? And of course, on the other hand, cost of funds will also come down.
Yeah, cost of funds is going to come down. As I said, the deposits, rate cuts for existing deposits will only happen when they mature.
Yes.
So therefore, the cost of funds will reduce over a period of time, not immediately. And on margins, we are still estimating, and I really can't give any numbers because we are in the silent period. As of now, the results are due. So therefore, what is the impact, I can't say at this point of time.
Mr. Tewari, good morning, Neeraj here. Just trying to hypothesize that if indeed further rate cuts are given over the course of the next 2 or 3 policies, would it be suffice to say that for the intermediate period, yes, it's a fleeting pressure on margins, but it may stay for the period that the rate cut cycle is on?
Yeah, till the rate cut cycle is on, I mean, this, as I mentioned, this current rate cut,
right,
passes into the deposits and legacy deposits over a period of time. And if there are any future ones, they will still drag this pricing in even further. So to the extent that the rate cut cycle continues, the lag in terms of deposit rates passing on will continue to happen.
Point well noted. Yeah, I mean, you mentioned that, just wanted to get that summary. Okay, great. Now, the second question is, sir, the belief is that as the globe melts, if you will, in terms of growth, all that can be done to help the Indian corporate and the borrower borrow should be done and is being done. Would you believe that this set of rate cuts would spur borrowing, whether on the Capex side or on the consumption side, but predominantly the Capex side? Because except for the government Capex, the private Capex has largely been amiss.
So if you, I mean, I would not use the word amiss. It's a very strong word.
Okay.
I would say that it is less as compared to the government Capex for sure. And what we are seeing, because we are a leading player in the project finance space, what we are seeing is that there is enough pipeline in certain sectors.
Okay.
But in other sectors, you are right. There was some initial deleveraging which happened, for example, sectors like steel, and other sectors, some consolidation is happening, but fresh capacity creation is not as much as it is expected. Especially considering that the RBI's figure for long-term capacity utilization is over 75%, which is when it is expected that fresh Capex will take place in a wider sense. So therefore, yes, private Capex is lagging the government Capex. But the rate cuts, they help bring down the cost for everyone, including the retail borrowers as also the corporate borrowers. But that's not a sufficient trigger for capacity creation, because that depends on the demand, expected demand, that depends on other conditions. So therefore, it's not a full reason for people to go in for Capex.
Agree completely, sir, and which is why I'm asking you, because it's a necessary condition, not a sufficient one. Demand is the sufficient condition, right? We don't have the inklings of demand as yet. So therefore, I'm asking the person who is at the helm of affairs in terms of lending, that are corporates starting to talk about borrowing in order to fund capex? Because one part of the equation, which is that the rates are starting to come off, and there is, I presume, decent liquidity relative to 6 months ago. So are the sectors which were not doing capex thus far starting to at least talk about this? The other aspect of this is also, of course, corporate balance sheets are fairly healthy, and the ability to borrow or fund is also not difficult.
Yeah, so corporates' ability to borrow has been really good in the last couple of years. Many of the bigger ones have deleveraged, as I mentioned. So therefore, lending capacity is not a constraint. And yes, many of them have been in conversation. Many projects are also under advanced stages, assessment or sanctions and all. That is all happening. So for us, actually, we have a full pipeline. We don't have a challenge on any of this. But in conversations, yes, conversations are already happening. What is coming in the way is the little bit of uncertainty which got created recently, and therefore people are examining what might be the impact in terms of tariffs or cost, how much to be passed on. So that probably may have a little bit of a pause for the moment. But those who are already into the expansion, I don't think they're going to stop it just because of this, and everybody hopes it will settle down sooner than later.
Just that's exactly my next question, Mr. Tewari. What is the thinking to prepare for any fallout of a global tariff war, impact on export-facing companies, impact on companies where their costs go up? Is there a review on right now on the kind of impact you may see even on your book?
So this is a continuous process. This event like this has to be examined by us in consultation with our clients, which is what we are doing, looking at those who are more exposed. As of now, as we understand, the duty is just 10%, and whether a higher duty will apply going forward, our hope is that the BTA, the bilateral trade agreement, will get signed, and therefore there will be a certainty. So more than the amount of duty, it is the uncertainty around it that is the challenge. And we are therefore examining with our corporates those who are more exposed, and are in conversation with them in terms of what support they might need. But for the time being, it is more of the analysis and hoping that whatever the tariff ultimately settles down will be a stable tariff rather than an unpredictable tariff, which is the case right now.
I just ask you a follow-up on that, on some of those conversations you mentioned. Have those conversations now begun with clients on what support that they may need, and what is the kind of ask coming in?
So nobody is asking for any lending support in terms of tariffs and all. That's not needed. What probably may be needed is, and this is very early actually, so we haven't actually analyzed the whole thing. And as you know, since we really don't know the final rate of duty, it's still a little premature to take any action. We are in touch, and we are getting the information from those who are more exposed as to how they see it and what should be their strategy. And our strategy will be just to align with the strategy and give them whatever support is needed. So nothing concrete at this point of time beyond analysis and beyond conversations.
Mr. Tewari, a fair degree of chatter over the last 12 months on the stress at the lower end of the food chain, if you will, and the marginal borrower being stressed, and it was showing in the MFI results thus far. People are talking about the turn of that MFI book for pure play MFI players as well as for banks having microfinance exposure. What is your view on this particular aspect?
So MFI, as a bank, we don't have too much exposure to MFIs. Whatever we have is to really good quality MFIs. And therefore, with them, we did see a little bit of increase in the NPAs last year, but it's now trending down. And our conversation with them tells us that they say that they have turned the corner, and this is now coming down. So therefore, that cycle seems to have passed. And in any case, we were not exposed too much. So as you have seen in Q3 also, we did not see any uptick in our NPAs into this segment overall, or the overall NPA as well.
But yeah, and therefore maybe not just from an impact on SBI perspective, but I did hear you say that it seems that the cycle is past. You do believe that the MF cycle could be turning for the better?
Yeah, that's what our conversations, as I said, we don't have too much direct exposure. So what we are doing is to have conversations with the leading MFI players, our customers, even otherwise, because we generally keep talking to various industry leaders to understand as to what their sense is on this. And this is what they are all telling, that the cycle has turned and this is broadly under control now.
All right. Thank you so much, Mr. Tewari, for speaking with us and giving us a sense. And this is why banks are becoming a safe haven for investors as well, because solid domestic-facing businesses like banks, which and especially large banks like State Bank of India, which are going to be holding on to the economic growth of India, is what the focus is. Let's talk about 0.5% up. Actually, it's banks that are working out today more than anything else.